take stock of important commentary coming in and news coming in this morning. In a largely expected move, the Federal Reserve held benchmark lending rates in the current 5.25 to 5.5% band. However, the central bank revised its outlook for rate cuts to just one in 2024 from the previous one, which was three as early as March. And when you take a look at central bank policymakers, they also noted that there has been modest further progress toward its 2% inflation objective. And in terms of commentary, then Chairman Jerome Powell also noted that the central bank does not have the confidence yet to cut rates, even as inflation has eased from its peak levels. Additionally, he also said that it is unclear why the sentiment of everyday Americans is so sour on the economy. And he also, despite a cooler than expected inflation print, the central bank had also refused to rule out the possibility of rate hikes. However, added that hikes were not the base case for anyone on the committee. So that's the commentary coming in. Let's also listen into exactly what else he had to say then.
The committee decided at the meeting to maintain the target range for the federal funds rate at 5.25% to 5.5% and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate.
Although that's the word coming in from the Fed Chair Jerome Powell, but let's keep it going with the US. The CPI print for the month of May held flat, although logged an increase at 3.3% on a year-on-year basis. Excluding volatile food and energy prices, the core CPI increased 0.2% on the month and 3.4% from a year ago. Price increases were held in check, though, by a 2% drop in the energy index and just a 0.1% increase in food prices.
Well, absolutely.
If you like this video, then like, share and subscribe to ET Now.